Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Today, guys, up early, just had the market close, nice and relaxed, and I'm going to talk about how I am looking to play this volatility that I see on the horizon. And we've already started to see that being reflected in certain markets around the world, particularly on the ASX over the last few days. There's been a lovely little sell-off. So I'm going to talk about yield roaching. I used to call it yield hogs, those that are in search of yield, particularly dividend yield or free cash flow yield. And I'm going to talk about my friend, the respeculator, and his term yield roaching. I'm going to change the terminology because yield roaching implies that you can survive like a nuclear holocaust. So that's why we're going with the old cockroach. I'm going to talk about what I look for in a dividend paying company, how I have confidence that will be sustained, and drop a few ideas for you guys. So make sure you stick around. Please do like and subscribe to the channel. Apparently, now that I've been taking YouTube more seriously, about half the views are from people that aren't even subscribed. So if I am adding some value, all I ask is that you like and subscribe to the channel. Drop me a comment. I would really appreciate it. Doesn't cost you anything, but it will help me out a lot. So without further ado, disclaimer, nothing I say is advice. It's just my opinion only. You guys know that. In terms of yield, if you're looking for options for yield, not just options, but dividend paying companies and how to really squeeze the juice out of that using derivatives, check out the link in the description to the Maverick Life. The portfolio is up 9.78% since inception, 1st of August this year. And a lot of this is using options contracts that roll over combined with dividends. So you're getting constant, steady income. So it's a little sub portfolio that I've carved out. So you can check that out for a free trial and a lot of free content anyway that you can get a taste for that particular publication. So dividends, be very careful would be my suggestion, chasing, just plugging into a calculator and looking at dividend yield. Why? Because it will be most likely trailing yield, and it may be a one-off in a cyclical industry, and there's no way for you, if you just stick to that, there's no way for you to know if that's sustainable. I take a sip of my mate to wake up. So 20% yield on cost is very possible in today's environment if you were starting from scratch. It's not as easy as it was, obviously, post the COVID sell-off. Okay. Now, in my humble opinion, that's where certain option strategies can really help get you a lower entry price and beef up your effective yield on the dividend, because you will be buying a stock at a big discount, and or other ways that you can continually sell income options on your dividend payers. And we've done this in the Maverick Life. People have seen we've been getting a 20% dividend stock or more like 25, and adding a good 5 or 6% easily over the course of a year by selling some sort of 90-day dated options. So I do suggest that is a helpful tool in the coming environment. One thing that I think just it really kind of changed my life in terms of how I look at things is what a constant dividend payer, at least one portfolio. You don't have to have your whole portfolio, obviously, with a dividend strategy, which I certainly don't have many portfolios for different strategies. But if you can put together like a little 300K portfolio, and let's just say, keeping things simple, that you can get a 20% dividend yield, that will spit out obviously 60K annual portfolio income. Okay. So if you really get to work and you save up some money, you can get to 300K. If I'm just speaking Aussie dollars, firstly, the average annual salary in Australia is, let's call it 69 grand a year. Okay. Now, if you do the conversion as of today, that's roughly 44,000 in the US. If you use it. So before we move on, actually, if you have a portfolio, you save together and you can invest, and with the ability to invest around the world at the moment, getting your overall portfolio to 20% dividend yield, spitting you out a 60K annual income, with which you can then do what you want. You don't have to live off that, obviously, and it's better if you don't. You just continue to reinvest it, obviously. That's the pure arithmetic of the situation. But that I think we all just need to pause for a moment and just get the average person to understand that, hey, that is a really, really good outcome. That can relieve a lot of stress for people and provide you with a lot more options. In addition to which, if you saw my last podcast with Rick Rule, where we talk about geo arbitraging your expenses, if you've got that portfolio, so you work away, you get, let's call it 60K a year, steady stream dividend income, and you reduce your expenses by various ways, one of which might be moving to a lower cost of living country, or having your expenses in a currency that's a lot weaker. If you can get your expenses down to 20K a year, that's a pretty good outcome. For the US brethren that are listening, and most of you guys, according to YouTube, your average salary, again, it's not the best one to use, but it's saying it's around 75K a year. I would suggest that if you were to look at a median rather than a mean calculation, it would be a lot lower than that. But it's just to illustrate the point that you could almost replace your income by being diligent, saving, getting some strategies together, and putting together a portfolio. And now we're going to talk about how to allocate that portfolio such that it would give you some income. So you can have an income portfolio, and then the rest you can have in other strategies like growth or whatever the case may be. Biggest thing when it comes to this, and I've harped on this for bloody 3 years, is getting how to get a sustainable forward yield is to look at free cash flow yield and the sustainability around those cash flows. So free cash flow, if it's easily covering the dividend with a management team that is committed to shareholder returns, mostly via dividends, but also buybacks are great as well. That's something that I've harped on and on about on this channel. So the great man, Respeculator, a fellow Aussie, so you can trust him. He says here, this is a great tweet that came out, I think yesterday or the day before. For the yield roaches out there, it's hard to go past Yanko, which I've spoken about on the channel plenty of times before. At a 5.5 billion enterprise value, that's Aussie dollars, doing around 1.8 billion EBITDA per half, so call it 3.6 billion per year, all things being equal, you're paying basically 1 times EBITDA. This is insane. For a company this size, 35 metric tons per annum at $50 a ton free cash margin, 26% yield, all else being equal. Now, it's not going to be that smooth every year, obviously. But if you're looking at the operating margin of about $134 a ton, it's not hard to see you could get at least a third, if not 37% free cash flow margin on revenues moving forwards, particularly if you listen to the interview with Rick, where I talk about coal and the demands that's really ramping up in the coal market. We're going to use Yanko as a way that I would look at a dividend payer. So case study here, looking for next 12-month yield and price to book value per share. And this is because this company holds a lot of cash. They have paid down all the debt. What you need to be careful of is a company that they have debt, and instead of paying off the debt, they pay out dividends. So a lot of REITs are kind of like this because of their legal structure. They have to do it. So be very careful with the REITs. I don't really like them in general. Obviously, there are exceptions. When it comes to basically, that's the Seagate era. So that's the short thesis around Seagate, is that they should have been paying down the debt and they haven't. And on the opposite side of things, it's the catalyst for a company like the Geo Group that has a lot of hidden value. They changed their corporate structure. So instead of dishing out dividends, they're actually paying down their debt. Their balance sheet is reducing. And in the future, in the very near future, in my opinion, they'll be able to pay very nice dividends. So you need to think about it a little bit more deeply than just simply looking at a financial statement and looking at their previous 12-month yield or what their expected yield will be. Where is that yield coming from? That's what we need to ask ourselves. So coal prices, that's a risk for a commodity producer, is if the commodity price tanks. We saw them go parabolic. That was the old gas fiasco last year in Europe, back down at around 150 a ton. Inflation adjusted, I think, obviously it can go lower, but commodities are volatile, but that would be a sustainable, I would agree, price, given that there's been no capex in coal, and the fact that China is adding the equivalent of another India in terms of demand, so 1.3, 1.4 billion metric tons is truly remarkable. So I don't think we're up here. I think that we're pretty close to a sustainable level. It may not be the bottom, but I think it's sustainable enough for young coal to be paying me a decent yield. And if you see my previous video on the company, I use a few different price targets for coal and what that would mean for the yield. So what about management? What are these guys saying? So this is the CFO. from the transcript of the conference call. So I'll just say cash position 1.1 bill, net cash 900 million. So it's basically a dollar a share once in pure cash, which if they paid all that out would be basically nearly a 20% yield. Young Coal closed 520. So it's almost a 20% yield if they were to just pay that out of their cash, not even touching their future earnings. Once again, returning cash to shareholders via dividends is the primary use of Young Coal's excess cash. So this is important. What are they going to do? They're going to invest in new coal mines? No. Are they going to buy out other companies? No. They're just going to dish it back until things change. The board allocated 489 million to the 23 interim dividend. So in Australia, generally speaking, you get two periods of the year where the dividends are paid biannually because we have this corporate franking structure going on. So it's different to the US. So 37 cents per share, call it, I don't know, about 70, a bit over 70 cents a share. Notional 8% yield. So if you, all else being equal and you double, we're looking at around 16% at the moment based on June share price of 458. The company had a bit of a sell-off because they had some issues in terms of production with water flooding and whatever else. That's going to happen. As I said, it's not going to be a smooth line. We've got to get a ballpark figure. And I personally am just looking to ride it out from there. So net debt, you can see how much debt they've paid down from over, and now they've had a large stack of cash. They've paid that out as dividends. And yeah, things seem to be it seems to be going fairly well. If you look at the shares outstanding, I think this might be the next shoe to drop. It may not be. They may just continue to pay out the dividend. But if the company were to get ridiculously cheap and had a bumper year, maybe they take some cash and pay out as a dividend and take some more cash and buy back some of their own shares, similar to what Whitehaven did last year with a record buyback where they bought back, I believe, nearly 20% of the entire float. Again, so from Kevin, the CFO, statement around dividend policy of Young Coal is the easier way. Young Coal is a simple 50% of either the free cash or the net profit after tax. So their policy at the moment is they add up the free cash at the end of the year or the net profit after tax, and then 50% of that is paid out as a dividend. So we want to look at what their free cash flow is likely to be or their NPAT, and then we're going to say, okay, about 50% of that is going to come back to us as shareholders. Okay, so other roaches out there as I wrap it up. Whitehaven at the moment it's around 11%. I think that they can, it might be flatter for a year or so. We're waiting for the fallout of this Daunia and Blackwater acquisition, but they can buy these bloody new mines with long, like more than a decade worth of production at like 3 times cash flow. And not only that, they're getting it vendor financed. Essentially, so they can pay that out of future earnings. The risk, of course, is what government royalties will be. Rick and I discussed that in the previous podcast. Petrobras sold off overnight, so this hasn't been updated. It's actually a little higher than 16% at the moment. Petrobras, in my humble opinion, is the new Aramco. Okay, they are the new Saudi Aramco. They, with their pre-salt and sub-salt drilling, their offshore cornering of the offshore market is extremely important. No one seems to be paying attention to this. Their ability to drill for offshore sourced oil around those Brazilian and Guyanese waters. I think it's extremely important, and the company has a policy of paying out the dividends. The government is a majority shareholder, and so their interests are aligned in the company continuing to pay out those dividends. Ecopetrol, out of all the producers in the world right now, I think this is the most undervalued out of the major vertically integrated players. And so I've been adding more capital on the recent sell-off. Not sure what people want me to say. There are many things very interesting about Ecopetrol. It's already over 20% yield that it's given me. I've been selling options on my stock to increasing the yield. I think it's closer to like 33% income yield that I've made this year on the stock. Now, one thing that's really, really interesting is the Colombian peso is still undervalued, but has been strengthening. And obviously, when that happens, it's almost like a tailwind to your dividend payment. So Chapman Scarborough and I discussed this in our latest podcast, which is only a few episodes ago, where what was calculated to be 80 cents per ADR in terms of US dollar dividend payments, because of the Forex fluctuation, it actually got bumped up to $1. So you get the 20% change just in the FX. DHT, free video available here and a deep dive available on the Substack, which you can check out below. 13.5% yield, and I think the company is trading at a discount, big discount to its replacement value. The demand for tankers is likely to continue to rise, given the fact that the shipyards are just tapped out and no one's building very large crude carriers. And what else do I need to say about DHT? So the policy is to pay 94% of their profits out as quarterly dividends. They've been doing that. They've been keeping their word, and their balance sheet is strong. Blackstone Minerals, a very high quality business, trading at double-digit dividend yields. So slightly lower than the others listed here, but this is a royalty company clipping the ticket on different oil production acreage. You can and could increase that yield if you really wanted to by using options and derivatives, something that I love to do. And then, of course, Cool Company, which I've spoken about. We did a deep dive, Chapman and I, in the last podcast as well. At the moment, analysts are saying like 15% in terms of the dividend yield. I think that's very, very low. I think they've already hit, or not, I think they've announced they've already hit in the first half earnings that analysts were expecting them to be their annual earnings. So in other words, they're earning at double the rate of analysts' expectations. I just think the analysts are no one appears to be covering this company clearly, because I look into the numbers and I don't agree with them. Anyway, you can check out my opinion on the company by the video that I have done. So I just want to bring this lastly, this sheet up. All I've done here is use a financial screen. It doesn't matter which one you use. There's heaps of them out there, and just said, okay, dividend yield of more than 10%. And then I just click the rearrange button for terms of lowest PE. Listen to this. You cannot simply rely on this without doing any further due diligence and thinking that you're going to get all this wonderful yield at cheap price. No. This will be using trailing yield. You need to, it's a good starting point for illustration purposes. That's the only reason I'm using it. Okay. But for God's sake, don't rely on that and think it's a strategy. It isn't. So we take a look through some of these that are still showing up. So Petrobras is in there. So it's at number 5. So we've got one. I also own Ecopetrol, as you know. I didn't buy Euronav. I do own some Frontline, which has gone through the roof. And what else do we have here? A few of these royalty trusts are ones that I'm super, super duper interested in. And so I'll be looking into some of those, perhaps do a deep dive on them if there's enough interest. So that's that. I'm pretty happy with where we're at. You'll see most of these are in the energy space, which is where I've been hanging out, and again, will continue to hang out probably for years to come. That's it, guys, for today. Please do like and subscribe to the YouTube channel. It's the only thing I ask if I'm adding value. If you want to take things to the next level, you can copy my portfolio on eToro. I think we're currently up 24% year to date. And you can hit me up on Twitter. It's not actually the ROI channel anymore. I changed my handle to the Maverick Life. Any questions and comments, I'd love to hear them in the comment section. Otherwise, take care, do your own due diligence, and I look forward to seeing you in another video shortly. Bye, guys.